Hi there. So the markets will always go through different phases. There will be a bull phase when everything is working, then there will be a bear phase. So the reality of market is that it will be cyclical in nature. And whenever it is cyclical in nature, what will happen is that with every cycle, there will be a new narrative. One day it is mid cap, another day it is small cap, some day it is large cap, gold, silver, US stocks will keep changing. So, what is very critical for any investor is the fact that when the markets go up, you should be able to ride it. When the markets come down, you should be able to sustain the portfolio. And that is where a balanced portfolio fits in. So, if our objective is to create a balanced portfolio which works well during the bull phase and bear phase, it should have a combination of right set of stocks and it should always follow that. And ideally, when we're looking at the outcomes, we should be able to see whether we're looking at it as a 7 day thing or, for that matter, a 4 year period kind of a thing. It is always giving slightly better returns or good returns over the market. And that's exactly what we are trying to cover over here. We have tried modeling this on a Google Sheet and we have picked up stocks which kind of provide the stability as well as growth and individual uh, goals are baked into it for it to give you the holistic view. And how do you implement something like this? While keeping in mind that the markets are always dynamic and they are moving, and how do you build positions in such a manner that you are getting the maximum from the market without losing your sleep. So that's what we're going to cover over here. We've created this on a Google sheet. Right now it is just a Google sheet, but we're going to layer agents on top of it later on and also have a process to sync it up. But right now it's just a manual flow which wherein we are bringing up everything together and just providing a framework to make the right decisions. And what goes on in putting up such a framework is what we're going to discuss. First and foremost, you should always pick up fundamentally strong stocks. That is definite. And I do cover that in a separate course, and I'll be providing the link for that also on how do you identify fundamentally strong stocks, whether you're picking them from growth, from stability, or momentum. And then you should be able to bundle them together in a basket which is having the right mix, because something which is in the growth phase, market would be giving a premium to it, and the moment a bearish phase comes in the market, whatever speculations and predictability market is trying to build around future earnings will always take a much deeper cut, and sometimes they don't come back with the same intensity as they are going up. That is why you can't just have growth stocks, you need to have stability stocks, you need to have growth, and then you want to layer it with momentum, tactical, income, and hedge, depending upon what your objectives are of creating a portfolio. So that's the first part of it. Now, once you've created this kind of a framework, you should be able to maintain it as and when the opportunity presents to allocate capital. You're not just allocating to growth, what is going up, or you're not just allocating to something which is very conservative to actually conserve your capital, but something which gets spread out and the portfolio keeps building strength from all perspectives. That's what the allocation of opportunity capital is based on opportunity. And then sometimes what happens is that there is weakness, you're going to make mistakes. Out of the five choices that you will make for stock picking or for that matter ETF, you will realize that something is not working out. You should be able to reduce when you figure out that there is either less conviction or that was a wrong choice. So if you are able to take these decisions at the right time with the right principles, you will be able to build a portfolio. And once you create this kind of a framework, you will develop a mindset, and that is very important for you to be able to beat the market. So that's what we're going to look at. First, we're going to look at how do you identify the right mix and what goes into making that right mix. So let us go back to our Google Sheet and just look at what are the different components that need to be put in place to ensure that you are following the right constraints when you're constructing the portfolio, be it from a position sizing perspective or be it from the mix perspective, that the mix works really well in the bull phase as well as in the bear phase. And how do you track the market to build the position at the right time, if not at the perfect time? So that's the model that we are trying to create. So first and foremost, in the metadata sheet, what we've done is we've brought in the different types of stocks, the categories that will need to be defined to get the perfect mix. The first and foremost is the stability, which forms the foundation for the entire portfolio to a certain extent, trying to build it from a long term perspective. What we have tried doing over here is just defining it, that yes, we want stability stocks, which means that these are not stocks which are doing going to be stellar during the bull run and you can talk about them. These are stocks which have reached certain level of maturity. From a business perspective, there is predictability built into the system. Markets always trust them, and when the markets go down, these are not the stocks which are going to get beaten down significantly, and then when the markets start swinging, you realize that they've never come back. These are those kind of stocks, and probably ETFs also make into this list. Growth is something wherein you're trying to bet. That's typically wherein maximum earnings happen typically, and you will spot your multi-baggers, but that is based on a bet that something is going to grow, and the market is already betting on it, and you are also trying to ride it. But the challenge on this is that you're trying to take a risk, and that is why you need to always be conscious that the mix is proper. And the way we have defined growth is that it is either going to be a multi-bagger, or you believe that in the next 1 year, in the fiscal, it is going to give 25 to 30% of a return. How do you find out these kind of stocks? We have a separate section which you can check out. I'll talk through that. Then we have hedge, because in the recent past, the gold and silver have given exceptional returns, and it is always better to have a hedge against currency depreciation, and that's where the traditional thing comes in, that have some gold in the portfolio, and you define that as one of the areas in which you're going to dip. And the markets are continuously moving, and if markets are continuously moving, sometimes there is a stock which doubles up in the next quarter or so. You want to ride some part of your portfolio on that kind of thing. That is what goes in momentum. But at the same time, what we're saying is that sometimes the momentum stock can also become the growth stock, but we have given part of it to that. And then we have the income stocks, because especially at least when this was being designed, we're assuming that a part of it is about conservation of the portfolio principle, and part of it is also because of the fact that if you are closer to situations wherein you want a fixed income coming from your portfolio, then income serves that purpose. Once this has been defined, one of the key things that we are trying to create is that the portfolio must have the right mix, and that is where we have defined the rules for each one of them. That okay, if fair enough, the stability is so much, the max it can take into the portfolio is 50%. It goes beyond 50, either reduce or bring in the growth stocks, or figure out how do you do that. So there is a maximum limit that you have put up for each of the categories, and then how many maximum stocks you can have, and what is the maximum position for stock that you can build. And now anytime you add a stock to the portfolio, and how do you pick and put the stock into the portfolio, obviously goes with the basic principle that it has to be fundamentally strong. You categorize it, that how are you viewing this particular stock, and what is it that it is going to service into your portfolio. Is it a stability stock? Is it going to something which is going to have significant position? And initially everything will start as an initial position. So you want to answer two very fundamental questions: what are you picking up, and why are you picking up, and what purpose it serves inside your portfolio. Once you have defined that, then you can bring in stocks as and when you discover them. Now that is one part of the puzzle, that yes, you gotten the mix correct and you define the rules around that. The second part of it is how do you build positions. So we've classified them into four areas: initial position, extend position, and like that, anchor and override. What it means is that when you are picking up, let's say, a momentum stock, and you're building position, and you're not very clear about it whether it is going to give you return or not, and after making a bet, if it starts dropping, it is going to be very risky. That is why what we've created is, you've defined a set of rules which says that okay, if you're building position in the initial phase, and whether it is for growth or for that matter for momentum, you should only build 1% of your portfolio into that particular thing. And once you're more confident, you can go up till extend position, and you can have different categories depending upon how much risk each of these categories are picking up, so that you're never over betting. So that is another set of rules. So now you've categorize the portfolio, the constraints around that, which stocks need to be picked up. Second is how you're going to build the position and what's the maximum that you can build on top of it. And then, as we discussed earlier, that we want to figure out when do we dip into it. So the markets are continuously moving, and you want to be able to figure out that this is the right stock to allocate my capital today, or this is the stock which is bleeding at this point in time, and should I actually, disinvest into it. That is where the first part of it comes in, that we have tried defining the trends. What are the different trends, and how do you figure it out? The basic concepts, not, of course, there are a lot of depth over there. You figure out that, and then you have all of this coming together on a watch list, which kind of tells which stocks are in momentum, whether they are the right ones to pick up right now or not. Because at least the belief over here that we have worked with is that only when the stock is in an uptrend, then try to build the position. While it is going down, even if you believe in the stock, just keep the watch list and don't dilute your positions, but can you do that? Now, all of these rules have been mapped over here. You've created a portfolio or a initial mix. And now, when it comes to making a decision, you have the dynamic part of the market coming in over here. You have the rules defined over here. And then, whenever you want to make a decision, what are the kind of decisions that we already discussed that you need to make? First and foremost is something in the overbought zone. Have I already that comes in over here, or you should be able to figure out that anything wherein I had only taken a bet at this level, is it already crossing that limit? So take for example over here, it is ITC. Your current holding is already 3.15, and that is not something which you should be adding more into it. Similarly, the PFC, that the current allocation is 3.45, and the rule says that it is already above the level that it should be there, because these are the places wherein it is, because these are income stocks. What are there are categories which are defined, and based on that, it is coming up over there. Now, so these are decisions that if you want to build further position into any of these stocks, then definitely you need to consider changing their this thing. Like CAMS is at 2.59, and currently CAMS is in the overbought, and CAMS might be a growth stock, which should not be more than 2.5%. So now, from a decision perspective, yes, that is one part of it that it is saying. Now, let's say you had a capital and you want to allocate, then these are the stocks which are currently in momentum. And now, if you want to allocate 25,000 or something, you can now decide that, okay, these are the four stocks that are coming out in the list which are in momentum. How do you want to allocate that? And the third piece of the puzzle, as I discussed earlier, is the stocks which are not performing. Now, in this case, right now, when I am recording, significant number of market is going down. It's bearish, and that is why a significant number of stocks that are there on the list are showing a bearish trend. But do you want to weed it out? At least it will show you. Now, you can always change this also, that I don't want this comparison to be just for 15 days, because this is all codified. You can change that. I don't want to see it as a 15-day, 30-day cycle. I want to see it as 90-day, 120 days. If you're doing your now your modeling on Excel or Google Sheets, you can do that. So based on this, now you can make decision. You can figure out what needs to be weeded out. You know what, where you are in the overbought zone. You can figure out where you can allocate capital. You can figure out where do you weed it out if you wish to weed it out. And you can start logging your decisions, like over here, that yes, Coal India on 10th of July, we said that we're changing the position from extend position to anchor position. Means you can buy more, because Coal India was also in a similar situation. And similarly, from a capital allocation perspective, that yes, uh, we want to continue to go ahead with Mafang, and because this is already in an anchor position, after anchor position, you're taking a call that you want to override, and you can add more. So, like that, you can craft your own strategy and then build your rules. And anytime you want to see that some rules are being overridden on your portfolio, you can get that. So this is the overall framework, the basic structure being the fact that whenever you bring in a stock, study it from a fundamental perspective, see what the role it creates, then create the right set of rules, and how will you like to track it and build your position. So I'll talk in the next section on how you can get access to it. Hope you got the gist of it, that the primary thing is the fact that you need to have a very clear framework in your mind. Jump to the wrap up and I tell you on how do you get access to the knowledge and all the details. Whatever stocks and whatever details we have picked up, they're just indicative. We're not making any kind of a recommendation. It's just to help you build your thinking. But the primary part is that yes, you should be able to get the right mix based upon your goals. So that's the key part of it. And over to the next part wherein we talk about how do you get access to this. Covered in this video was two parts. One was, of course, the principles in what goes on in making a balanced portfolio, and then we brought in a Google Sheet which brought in all of those rules together and helped you implement it. Now, if you want to do it all by yourself, and you know the principles well, or you're willing to investigate by yourself and you just want the tech part of it and the very basic one, you can take this course which is available on our website, that is tismos.net domain finance. So you can just go over here and the link is available, and this will give you all the fundamental knowledge that is required for you to create a template like this, and it'll also give you the basic knowledge of the uh, stock market. Now, if you want all the principles in detail as well as a ready-made template, then you can definitely, I would recommend for the sake of business that take this course, build asset portfolio, and definitely I'm sure that if you can afford it, which is very reasonable price, you will have takeaways for a lifetime. And I will also give you access, at least for the in the initial stages, access to myself to have a discussion on this, and it will give you a template and it will give you also the knowledge that is required to, you know, break down your investments into safer bets and into the stock market, come up with principles all, and understand the different asset classes that are available, and ready-made access to this particular template. So I welcome you to try this out, be it from a foundation course perspective or from the perspective of trying out this build your the build asset portfolio. And we will be also layering more courses over here, or knowledge around how to build technical solutions on top of your personal finance, or for that matter, other aspects of life. I'll see you in the next one. If you liked it, do like and subscribe. Consider taking the course. And I wish you good luck with everything that you do in life. Bye for now.